Now I welcome Mr. Siddharth Vora to give his presentation on conviction capital. Just to introduce Mr. Siddharth, he is an MSc in Business Excellence from London. He is also a chartered accountant and a CFA. And on top of it, Siddharth at this young age is heading investment strategy and product research division for PL, and he is instrumental in building a research stack which has many different kind of research which are driven through various kind of parameters and filters and scenarios. For example, acumen series, macrometer, quant analysis, and many more, which Siddharth will take us through in his presentation. So I will hand over to Siddharth. Siddharth, the dais is all yours.
Thank you so much, Piyush Bhai, for the introduction. And I'm actually very delighted to introduce all our partners with our newly launched service, Conviction Capital. As it's clearly mentioned that it's a very specific boutique offering for family offices and HNIs, and we call it the on-demand team of investment specialists. So we have a 360-degree universe of advisory that we offer to our clients based on their requirements, their particular needs, and we tailor make it to each and every client's individual profile. And the breadth is between asset allocation strategy, portfolio construction strategy, portfolio rebalancing, technical and derivative advisory, quant analysis and quant-based advisory, sectoral allocation review, mutual funds advisory, international equities, alpha and trading strategy. And basically, we've just launched this on, say, the 4th of April. And within 2.5 months, we have 60 crores of assets under administration. And hopefully, as everybody understands the product and its nuances better, you guys will help us build a much larger AUM in the times to come. So what products do we really offer? So we have strategic portfolios, we have thematic portfolios, we have dynamic multi-asset portfolios, we have MF portfolios, which is a combination of different schemes across different asset classes that we create for clients to generate better returns than the markets. We also have quant-based portfolios and curated advisory, which is a very specific personalized service for family offices. So what is our investment approach? We follow a top-down scientific approach, which balances the 4 key parameters: protecting capital, creating wealth, generating alpha, and doing this consistently. And for doing anything consistently, what's really important is that your systems, your processes, your frameworks are very well laid out and clearly defined, and they must have a scientific backing. If we do things only based on our intuition or judgment, we can get it right once, twice, 3 times, but to get it right more than, say, 70-75%, there needs to be a lot of science that goes behind it. So over the last 2 years, we've worked rigorously to build the science and the processes behind systematically managing client assets. And I'll just quickly take you all through the broad process that we follow. So we start with the macro regime, where we use our proprietary indicator macrometer. Then we look at the market cycle, where we use our proprietary quant indicator CYCLOMETER, which gives us the range of valuations, whether the markets are overvalued or undervalued, and which phase of the market we are currently in. Then we look at our asset allocation model, which balances how much of your total asset at any given point of time should be divided between equity, debt, gold, and international assets. Again, this is a scientifically created model, so it gives us how to allocate during different phases of the economy and different phases of the market. Then we come to the portfolio strategy, and we use two two key tools here. One is our stock grid and the other is value meter. And I will take you guys through this as we go along. Then we identify the sector and theme that we want to invest in using the PROV framework, which means potential, resilience, outlook, and valuation. This gives us a balanced approach to build conviction on a certain companies within a certain sector. And finally, because we are all market participants and markets do not always reflect the economic reality in its true nature, markets either discount the future too much or too less. There's always some kind of excessive optimism or pessimism in the markets, and hence it's very important to understand market sentiment. And we've tried to create a science and a quantifiable model to understand this called SENTIMETER, and I'll take you guys through that also. Then we select our stock universe using the red flag grid, scorecard, and the decade decoder tools that we've built. Finally, once our universe is in place, we use the mosaic framework, which focuses on quality, growth, and moats to really shortlist which stocks we want to hold in the portfolio. And after the stocks are selected, we use the value decoder quant tool to decide what kind of valuation comfort we have in which of these stocks. And based on that, we keep switching our allocations by going overweight or underweight on stocks as the risk reward profile changes as the markets evolve. Finally, we have a very strong focus on alpha. We do not believe that as the markets become more and more efficient with technology, algorithms, and quant funds around the world, long-term value investing on its own has more relevance. So we also believe that short-term alpha, short to medium-term profit booking is very important to make sure that the long-term portfolio is built, but at the same time, profits are booked time and again. And the last one is portfolio rebalancing. Once we build a portfolio, it's very important to continuously review and rebalance it. And for that, we use our Conquest framework. So what's our performance been since the initiation? So we generated 34.5% in returns since the launch on 3rd April versus Nifty returns of 18.2%, thereby generating an alpha of 16%. Our unique strategy allows us to book short-term profits in a small universe of quality stocks while also building a long-term portfolio of multi-year market leaders for our clients. So how do we do this? So this is the whole suite of products that are and tools and quant frameworks and algorithms that I was telling you guys about. We call it agile research. And the word agile means we need to be nimble, fast, and accommodative to make sure that the markets, the economy, and the changes in the markets and the economy are factored in by us and we act according to them. I already took you all through all the key names and where we use it. Now I will take you all through the details of each of these tools. But what we really want to highlight here is that over the last 2 years, Prabhudas Lilladher has, in a very focused way, invested in innovation and technology, not just in the way we do our transactions, but also in the way we do our research. And that's why we blend the 75 years of wisdom of Prabhudas Lilladher and new age technology to create unique solutions and build deep moats that nobody can replicate in a very short time. And we will continue to do so as we go along. So this is just to give you a glimpse of the macrometer. It gives us a framework to identify or predict the state and the quantum of the future economic growth in India by using 50 to 60 unique economic indicators. I will not take you all through in too much detail because we'll have a different forum for that. But this is just to give you a glimpse of all the key products and tools that we use. So we use industrial and production indicators like the ones we see on the screen right now. There are 25 of these. Then we use consumption related indicators. Then we use banking and financial indicators, and we use external indicators. And broadly, all of these give us a very clear idea of what's going to happen to the economy before it's already happened, and hence we can stay ahead of our game. Then we also see how markets always discount future economic growth much more in advance, and hence our asset allocation strategy and portfolio strategy is shaped using the inputs of the macrometer. So what does the macrometer say now? It says that in April, we saw very sharp deceleration and a marginal recovery in May. And we also saw that in April, we breached the 2008 levels in terms of economic slowdown. And hence, the portfolio, in terms of its conservativeness, its resilience and asset allocation, must factor these things in. So what is our asset allocation framework? As the market regime and the economic regime changes, different asset classes become more attractive or less attractive. And we use a proprietary algorithm to shift our weights between all these different assets in order to consistently generate positive returns and in order to generate alpha over just investing in a single asset class. And this is the broad template of how we shift between asset classes across the different phases of the economy. So we probably allocate overweight in large cap, mid cap, and small cap during steady and strong growth, but we allocate very highly to gold, government securities during slowdown and deceleration. And then again during recovery, we allocate overweight on large cap, mid cap, and small cap. And doing this shifts gives us a very unique way of generating returns for our clients. So the dynamic asset allocation strategy gives us a return of almost 15.7% CAGR over the last 15 years versus the next best return, which was provided by gold, which was 13% CAGR, and Nifty or Sensex provided a 12% CAGR. So we could really generate a consistent alpha of 3.7% every year over just a simple indexing strategy. And that's what makes a dynamic asset allocation framework very interesting. Then I told you all that we look at the cyclometer to map the market cycle. So these tools give us exact zones when markets are deeply undervalued, or highly overvalued. So if you guys see the chart, it clearly shows us that in March, we got 3 to 4 different readings that the markets were in a deeply undervalued zone, and rightly so. And we saw a one-way pullback rally since the March lows of 7,500 odd levels. And we also saw that in January and December, we got market signals of being in the highly overvalued zone around the 12,300 to 12,500 levels. So the whole science behind all these indicators is to make sure that we protect clients' portfolios and generate alpha. So we use a lot of different indicators like your market cap to GDP, India VIX, price to book, price to earnings, earnings yield, bond yield to build this cyclometer. And this is what helps us in navigating the portfolios through the dynamic and volatile markets. And based on the cyclometer, we've divided the market into 5 key phases. One is acceleration, the other is deceleration, third is trough formation, which is nothing but your bottom formation. The next one is recovery, and the last one is peak formation. Based on the readings of cyclometer, we get indicators as to which part of the market phase we are in, and based on that, we make sure we navigate our portfolios accordingly. And this is to just give you a quick glimpse of the proprietary stock grid that we've created. Each category has stocks based on its historical fundamental performance and historical market performance, which includes returns, sensitivity, and volatility of the stock, over and above how the sales, profits, and other fundamentals have grown over the years. So I'll quickly tell you all the 11 categories that we use to shape our portfolios. Defensives, protective winners, stalwarts, emerging leaders, turnarounds, asset plays, strugglers, laggards, economic cyclicals, sector cyclicals, and commodity cyclicals. Each of these categories have their own nuances, have their own advantages, and every category has to be timed very well in terms of when to go overweight a certain category and when to go underweight a certain category. And that's what we really focus on to make sure, irrespective of where the markets are heading, we try to find some stocks or some categories that can help us outperform. And this is just to show you as a template that the Nifty 50 stocks, how do they fall in these categories? So we've done the exercise just for y'all to understand how we can classify a Bharti Airtel as a defensive and a turnaround, how only 2 companies in India fall in the protective winners category that protect us during a falling market and give returns during a rising market. And they are Britannia and Nestle. Then we look at companies which are stalwarts. Stalwarts are basically market leaders that give you positive relative return during correction and during the subsequent peaks. So we have stocks like Asian Paints, Kotak Bank, TCS, Ultratech Cement, Hindustan Unilever, and Bajaj Finance that we classify as stalwarts. Lastly, we also have categories which we call laggards that always underperform the markets and the peak and the trough. And these are stocks which we prefer to avoid mostly in the portfolios. Things like NTPC, Coal India, Power Grid, Bharti Infratel. And another important category is economic cyclicals. These really give you the high alpha if you time them right. If you pick the right cycle and if you position your portfolios in the economic cyclicals, in the right recovery phase of the markets, these are the stocks which give you the highest returns. We have companies like ICICI Bank, State Bank of India, Titan, UPL, Bajaj Finserv, and Axis Bank falling in the economic cyclical category. And this is just to show you how our categories have performed during the different phases and the different market cycles since the global financial crisis. And the performance trajectory of our stock categories during the current crisis, which shows us that we've overweight on protective winners and defensives during the slowdown. And as the markets corrected to just 79, basically 21%, our categories outperformed by 35% because of the category allocation. So it's always important to be in the right place at the right time. And we've tried to identify a science behind doing that. And this is just a snapshot of which companies fall in which categories. And I'm willing to take a personal session on these categories on another date. And how we position our portfolios during the different phases of the market cycles. So this was just to give you an example that during the recovery and acceleration phase, we go overweight on economic cyclicals. During a deceleration and trough formation phase, we go overweight on defensive, protective winners, and stalwarts. During a peak formation phase, we go overweight on strugglers, asset plays, and stalwarts. Like this, we have a template of navigating each phase of the market. Lastly, we have a framework for sector allocation also based on the macrometer and the cyclometer, which shows us between the key sectoral categories how we go overweight and underweight through the different phases of the market cycle. And lastly, the most dynamic tool we call Sentimeter. We've almost worked on this for 9 to 10 months with rigorous back testing to make sure that we get the market sentiment and the market timing right. However much people say that market timing is tough or impossible, we've tried to build a science and framework behind that. And to everybody's pleasant surprise, we have an 84.2% accuracy in the 30-day directional index, which means that every time Sentimeter gives you a buy call or a sell call, 84% of the times we are right about the direction and the quantum in a 30-day period. So the Centimeter is a very complex and nuanced tool, and we use a lot of different indicators from fund flows, gold prices, market breadth, relative sectoral performance, bond yield, earning yield, the macrometer itself, the short-term and medium-term RSI, market divergence indicators, valuation indicators, polarization indicators, WIX value, IPO indicators, and the international market indices combined in a very defined way so that we can daily get an update on what the Centimeter is saying and how should the portfolios be balanced. And following the Centimeter has yielded superior returns. So we've been able to generate a CAGR of 18.1% in our backtest versus just 4.9% of the Nifty 50 over the 3.5 years of testing the Centimeter. And some of the interesting calls given by the Centimeter in the recent times that y'all could probably relate to, I've just highlighted a few of them. So on the 9th of January, to the 20th of January, we got sell and reduce calls repeatedly at 12,225 levels. Then we also got sell on 17th of February at 12,000 levels. And finally, we got a buy on the 20th of March at around 8,700 odd levels, going all the way till April at 8,200 levels. So what this really does is gives us the confidence and the conviction to go ahead and make a transaction and make decisions for our clients when the markets are either excessively optimistic or excessively pessimistic. So during this whole fear and panic, we could go and buy things for our clients using the readings of the Centimeter, and that has given us the extra alpha of 16% that I explained you all above. After all the quantitative tools that we use, we also have qualitative tools, and we use the proprietary Mosaic framework for the same. And Mosaic is based on 6 key principles of management excellence, opportunity and growth, sustainable edge and scalable model, advantageous capital framework, innovative and agile, and cost value gap. I can again do a session on Mosaic on another date, but today is just to give you an idea of how we really do it. And for rebalancing and agile management, we use something called the Conquest framework, where we look at change in long-term fundamentals, outlook on near-term growth, new age disruption and changing consumer trends, quant indicators, unpredictable material events, extreme valuations of companies or market leading to irrational euphoria or panic, sectoral allocation indices, and technical indicators to give us an edge of how to rebalance our portfolios. This really helps us to answer 2 questions: when to buy and sell, which part of the market. And some of the key winning decisions identified, some winning ideas identified by us for our clients have been IRCTC, Avenue Supermarts, Britannia, Muthoot Finance, Bharti Airtel, GMM Pfaudler, Affle India, NAM India. And lastly, I would like to also bring out the importance of diversifying every client's portfolio. All of y'all should make sure that at least 5% of your clients' assets are diversified outside India into the US equities, because in the post-COVID world, where everything is going to be dependent on technology, innovation, you can only get exponential growth from a country, from an economy that gives you a tech play. And as of now, America provides you the best technology play, given the stimulus package provided by the Fed and the kind of investment opportunities in America. One must make sure each and every client diversifies their assets into US equities also. And now we have a platform. We're the first broker in India to give you a DIY client-friendly online platform for international investing at 0 brokerage. And you guys must utilize this opportunity to make sure they diversify. And this is just to show you, even if you all don't pick stocks, just an S&P strategy can also give you much higher adjusted returns over long periods of time compared to the Indian markets of Nifty and Sensex. So the S&P has yielded around 15% CAGR over the last 10 years versus Sensex, which has yielded only 6.7% CAGR. And this shows you how you get the dollar asset, dollar appreciation, technology play, everything in the S&P. And finally, it's also important for you to understand why investment advisory as a service, as a product is very important and different from mutual funds, from AIF, from PMS and direct equity. We have no exit loads. We have 100% customization. It's possible to trade. It's possible to hedge. It's possible to get fully customized services. It's possible to get direct research advisory for the client himself. We have no lock-in periods. The assets are held in clients' accounts, not units. We use agile rebalancing, and we also have 100% control for stock selection and sector selection, which we can do dynamically. When you buy a mutual fund, you have no control on entry and exit of a single stock. But in investment advisory, you have all the flexibility to do the same. So it's very important for you all to understand the advantages and the nuances of investment advisory versus the other investment products and pitch accordingly to your clients. And finally, I come to the fees and the plans. We have 3 plans. One is zero fixed, the second is hybrid, and the third is zero share. In zero fixed, we charge no fees, zero setup fees, zero advisory fees, but we have 15% share of profits, up to 15% of profits, and 30% share of profit above 15% of profit. There's no hurdle rate. There are no annual account fees. The invoicing is quarterly. We use the high watermark principles, and the returns are calculated as total absolute returns on average capital deployed. In the hybrid plan, we have 2% per annum as advisory fees, 20% share above 12% of profits. The hurdle rate is 20%. And in the zero share, we just charge you 2.75% as fees and nothing as a profit share. With this, I would like to conclude my presentation, and I would just like to introduce the diversified team that we have. We have Amisha Vora, the Joint Managing Director, myself, I'm heading Investment Strategy. We have Vikram Kasat, who's Head of Advisory, Vaishali Parekh, Head Technical Research, Pankaj, who's heading Mutual Funds and Wealth Advisory, Piyush, who's heading Investment Products, Shaili Parekh, who's heading Ideas Research, Ritika Chhabra, who's our Macro Strategist, Shilpa, who's a Derivative Strategist, Saket, who's our Quant Analyst, Nidhi, Archit, who are our Research Associates, and Manoj, who's our Client Support. So with that, I would like to conclude the presentation for the evening. And for any queries, I would like you guys to email me on convictioncapital@plindia.com. Thank you so much, everybody.